Okay, guys, welcome back to episode 4 of the Tax Sisters. We are super excited to go over our last corporation of our 4 episodes. We're going to talk about C Corps today. Dee, you ready?
I'm as ready as I'm going to be.
Sweet. So we're going to kind of go over the characteristics, kind of the all-over definition of the C Corp, how to, from the formation to the structure, some advantages, and then we're going to dive into, tax treatment, debunking our common myths, and kind of just preparation and tips and tricks for the C Corp, right?
Sure, sounds fun.
So fun.
Let's do it.
So let's start with, what is the C Corp? Do you give us an overall gist of what's going on
Well, the fun thing about a C Corp here is that it is its own, I call, living and breathing entity, separate from its shareholders, unlike an LLC where they're not shareholders, but the members are the owners of the LLC. In a C Corp, the shareholders the entity is actually its own thing. It lives aside from the shareholders. So if you think of one of these big corporations like Amazon, and Jeff Bezos not even there anymore, like these live in perpetuity. They don't need the original founders don't need to stay a part of it. These entities can keep going. Shareholders come and go, they change. So they are definitely much more powerful in that regard. Plus, we talk about the limited liability aspect, which is nice for the C Corporation shareholders because they are only liable, or they have limited liability from the entity level. They're only basically in it for what they have contributed into the business or purchased their shares for. That's their extent of their liability. The C Corporation is able to enter into its own contracts. It can enter into its own debts. It can buy own assets.
Got it.
So it's definitely kind of lives on its own.
Yeah, for sure. One of the other things people talk about as well is the capital portion of C Corps. Tell us a little bit about raising capital, what it means to the shareholders.
Yeah, one of the big things that are big benefits to using a C Corporation is if you're a business that's looking to grow rapidly or expand rapidly, the C Corporation has the ability to raise capital by selling shares of stock. Okay. So that is a very easy way and rapid way to be able to basically raise funds, attract venture capitalists, attract shareholders into investing into the corporation because they're getting something in return. They're getting those shares of stock.
Okay. Awesome. Yeah, so let's roll into like formation and structure. How do people create their little baby C Corps? Can you go from something to a C Corp? Do most people just start from the ground up? How's the foundation laid?
Well, the C Corporations are started out fairly similarly to our other entities. So each state is going to have its own regulations on formation of the C Corporation. Here in Arizona, it is a lot like the LLC. We can go to the Corporation Commission. We can create the formation docs, which will require us to have a set of directors for the business, initial stock shareholders, all of those things in the formation. But they get more complex because of the high regulations around C corporations. So there are more documents that are required, such as basically your bylaws, which basically tell the company and its shareholders how the business is to be run. It sets up all the infrastructure that the C corporation is going to need to operate. Yeah. So that's, I guess you can kind of equate that to maybe an operating agreement like we've talked about in the past, but the bylaws are definitely dive into a lot more
is structure. It like the voting and how people come in and come out, who makes decisions? Okay.
Correct. And then in the, there are going to be shareholder agreements and stuff like that. So what types or what classes of shares do we have? What types, because we can have founder shares, we can have common shares, we can have preferred shares. There's quite a few different levels of shares that can be laid out, and what we do in that document is lay out what the different, for each type of share, what type of dividends are they eligible for, what kind of voting rights do they have, what type of eligibility do they have for assets if the company was to dissolve. So those types of agreements are all set up in place in advance.
Forefront, got it. You mentioned talking about directors being appointed and stuff like that. What kind of roles are mandated within the C Corp? Is there a good variety of them, or is there normally just strict ones?
As far as what roles the company.
Yeah, I mean, you talked about shareholders and directors. Do they have board of directors? Do they have officers?
Yeah, so typically you'll see a C corporation will have a board of directors, and that usually sits over any of the people that are elected into office, like the CEO or the CFO or any of those higher level positions. They're usually hired by the board, and the board answers to the shareholders.
Yeah.
So that's typically how those are regulated.
Cool. You touched a little bit on the limited liability protection for the shareholders. Kind of dive in a little bit more around that. Like, what does that mean for the shareholders?
Well, as far as limited liability, in the shareholders world, because they are separate from the C corporation, they really don't have any liability associated with the corporation other than their investment in the corporation. Meaning, corporation goes under, your investment can go under, just like any other type of stock that we own. That's what they have at risk. But as far as liability, that's usually the extent. Now, when we start talking about, you've heard of terms of like the corporate veil.
Yeah.
And what does that mean? I like to call it more of a wall than a veil. But, we like the C corporation, because it operates on its own, we have to make sure that the shareholders or those in charge, those maybe the CEOs, CFOs, they're not commingling. They're not entering into contracts that are going to make them seem like they are doing something egregious to the company, where they can become liable for certain types of decisions and so forth, and allow the legal system to get through the corporate veil. But typically, if you see a C corporation, they get sued, and basically they're awarded the person that sued them is awarded a $10,000 whatever. That is the company's liability. It is not the liability of the shareholders. They would have to prove some type of egregious action to get through that corporate veil to get to make the shareholders liable.
Got it.
It does happen, but
yeah, I'm sure it does happen every once in a while.
Yeah.
Is there a max number of shareholders, or they can just add?
Well, there is not unlimited number of shareholders in a C corporation. So there is no max number like there is with the LLCs, where they're capped at 100. So typically you'll see a C corporation issues a certain amount of stock that is available to raise capital. Now they can issue, if they run out, they can issue more, which just dilutes the current shareholder base. Yeah. So but in general, there is no limit to the number of shareholders that can be.
Cool. All right. Now for our second segment, we're going to jump into it. Jump right into the tax treatment of C corporations. We're going to talk about the corporate taxation, double taxation, the gist about retained earnings and any tax deductions, which are normally just our regular tax deductions, but we're going to touch on it. So let's jump into corporate taxation. Tell me a little bit about that.
Well, one thing that's different about C corporations versus all the other entity types that we've talked about, especially our LLCs, is that because C corporations are tax paying entities,
right,
not pass-through entities. So those are the two things that we're looking at. Our tax-paying entities, they actually report and file their own taxes. So they pay their own taxes.
Estimated taxes.
Yeah, back in, after the Tax Cuts and Jobs Act, we used to have a fairly, I would say, a more complex C corporation tax structure that maybe mimicked a little bit more of like our personal escalated version of
the more you grow, the more you owe.
Kind of thing. Except we have now since cut that back to a flat 21% across the board, which seems nice. Was a good nice break for C corporations,
right?
Especially when we start looking at in a minute what double taxation looks like. But C corporations do report and pay their own taxes, just like we report and pay our own taxes. So they're definitely a little bit more, structure around what goes into filing that 1120, which is the tax form we use to prepare our C corporation taxes.
Got it. And do corporate C corporations, they pay state taxes or just federal taxes?
No, they pay both. They have, every state's going to be a little bit different about what their rules are on corporate taxation. I know in Arizona here, I think we're sitting at about 4.9% for C Corp tax rates, and every state's going to be different. I know California is probably one of the highest at 8.8. Don't quote me on that, but I think it's somewhere around there in their state taxation rate. So they are doing just like us. They are reporting federal and state, and depending on the states that they operate in, right? So if you have a C corporation, like maybe local to Arizona, that's one thing. But when you have a C corporation like Amazon operating in all 50 states, you have to deal with the taxation levels of all of these different states, and
they're piecemealing to every portion.
Absolutely. So we have like apportionment issues and all of that kind of stuff. So they can get pretty complex pretty rapidly.
Got it. So let's touch on the double taxation. A lot of people are always like, C Corp isn't the way to go. Everyone gets double taxed. So let's touch on that.
Well, double taxation is real. So, I mean, that's definitely a fact. And the way you get double taxed is really at the shareholder level. So the C corporation is going to pay taxes on its profits that they make in that year, which they can choose to retain in retained earnings. So that's another word there that we will hear a lot in C corporations, retained earnings. And they can reinvest them back into the business, and they don't need to disperse them out as dividends or anything to all the different shareholders.
Right.
So in that regard, at that simplistic level, there isn't double taxation. What happens is when companies are doing really well and they decide, hey, we profited 100,000, company paid their taxes, but we'd like to take 50% of that, maybe 50,000, and issue it as dividends to our shareholders. So now, depending on the class of shares, let's just, for simplicity, call it the common stock. We're going to distribute this 50,000 to all of our shareholders, and then depending on what they're each going to get based on how many shares they own. Then that gets distributed. Now, that dividend is taxable to the shareholder. So shareholders can't get their money out or their earnings out of the business without being taxed again on the money that was already taxed at the C corporation level. So that is where we get the term double taxation. Now, there's ways to mitigate that and push those things out by doing different types of reinvestment and stuff into the business. But that is what usually gets people, is that
people,
when they want to get the money out, then there's also another layer of taxes personally that you need to pay on that.
Understood. One thing that that's a requirement in some of the other entity structures, like the S Corp, is like mandatory, owners or members taking, W-2 payroll. Is that a necessity with the roles within the C corporation?
Well, yeah. If you have, if you're serving as a director or a CEO and you have a level of, you're providing a service to your business, usually you are getting paid for that. Now, you can get paid in stock, because I know some companies will, in the early stages, pay their employees in stock. They still have to pay payroll taxes. They're still going to get a W-2.
Right.
So typically those positions are earning a wage, and it could be a wage in addition to some type of stock or stock options, but that is typically how it works. So in that regard, Bo, however, wages, and then we're going to get to this in a second about tax deductions, but wages, benefits, those are all deductions for the company.
Right.
So if I'm the CEO and I made $100,000, that is $100,000 that I'm going to write off. That's going to come off of the profits. However, dividends that the shareholders or that the corporation may issue to its shareholders are not deductible. So those are just a piece of like taking a subset of your retained earnings and then allocating those out. But those are not deductible. But corporations have some other interesting, there's lots of things out there, and I'm kind of oversimplifying, but there's research and development tax credits. There's usually, if healthcare, if they're providing healthcare, plans to their companies, there's different types of tax credits and stuff that the C corporations can utilize to, so to help with some of that. So that's available.
So on the C corporations, for the tax deductions, they flow almost exactly the same as other entities.
For the most part, yeah. Definitely, for the most part, when you start looking at your your office rent and your wages, your benefits, and
Goods and services, all those
all of
things.
that things,
Yeah.
software, everything. Like that's all typically tax deductible to a C corporation, just as it would be to an LLC.
Yeah. Is there anything on a one-off that you can think of that a C corp can take advantage of that another entity couldn't?
No, he's trying to stump me on that one.
No, I didn't think so either. I was trying to think over.
I'm sure there are plenty of things out there, but off the top of my head, I'm not aware.
Cool. All right, let's talk about retained earnings. Many people, I mean, one of the things we get asked a lot from the people who come into us, even if they aren't C corps, is how do I grow my retained earnings? I want my retained earnings to be higher. Well, what is retained earnings? Why are they?
In a C corporation, retained earnings are exactly, if you looked at the definition of retained earnings, those are your earnings, your profits that you earned in the business, and you are retaining them in the business to reinvest in its growth and expansion typically. So your retained earnings will fluctuate up and down.
Yeah, depending on profits, losses, depending on the year, right?
And what you distribute as dividends and so forth.
What you took out. Shit, cool. Are retained earnings taxed in any way?
Well, your retained earnings are exactly taxed because those are what derive where you're getting your profits from. So it's your profits that are taxed. It's just the retained earnings is the bucket that it'll fall into. Say if you have $100,000 that was taxed, but you only retain $50,000 and distribute dividends in $50,000, then you're going to have a little bit different piece of the pie there.
Understood. All right, here we are. We're going to jump into our debunking the common myths, all the things that we hear on the YouTube, the Instagram, TikTok. I don't watch TikTok.
I don't watch TikTok either. It's not allowed in my house, but hey.
Yeah.
I do see people repost TikToks on Instagram.
Yes, they do the repost. So let's talk about some of the most important ones that I pulled here. So the first one, and probably the one that we hear the most, is that C corporations only benefit large companies.
Yeah, and I can see why people think that. Typically out there in the world, where we think of C corporations, we're thinking of things like Coca-Cola, Amazon,
Apple.
Why am I having a hard time thinking of some? Big corporations that are very present in all of our lives, and that is very true. So, but they all start somewhere, and I think what people need to remember that C corporations have a very powerful place in smaller business and medium-sized business, but typically when you're choosing an entity type, and if you're going to look at a C corp, it's because of a couple of really profound reasons. One, you definitely want that situation where it's its own entity and it's separate from the shareholders. But the biggest one is because you're looking to expand and grow rapidly, and you're looking to raise capital because of its ability to attract investors and raise capital and sell shares, and allows for very rapid investment rather than typically our smaller businesses that are basically trying to grow based on the profits that they bring in. These corporations are able to raise a lot more funds by selling shares and so forth, which allow them to expand much more rapidly. So I think that's the big attraction to the C corporations, and I think that's what we fail to forget is that they do start out small. And the reason you might choose that is because of the reasons of allowing us to expand rapidly, attract investors and raise capital.
Yeah, they're trying to find their Shark Tank investor, right?
Yeah, exactly.
All right, the second one is something that we touched on just right now, is that that C corporations always pay more taxes due to the double taxation.
Well, while it's true that double taxation does exist, I don't think it's true that they always pay more in taxes. Now, like I said, when we were looking back at when a lot of these changes happened, and after the Tax Cuts and Jobs Act, we have a flat C corporation percentage. It's not that they're going to always pay more. But the double taxation piece is real. So you have to look at how a company is going to mitigate its tax situation and really plan appropriately, because double taxation isn't necessarily ever going to go away, because you can push it out in time by constantly reinvesting, not giving out any dividends to the shareholders, but ultimately, eventually that's going to push its way down to the shareholders, and the double taxation is never really going to go away. But if you can delay it when things are in a better position or lower taxes or things like
Different
that.
strategies, all kinds of things.
There's different ways to mitigate
And we see a
that.
lot of that when it comes to like different presidencies rolling around, right?
Yeah.
Other rules come out and people use the different things that come out every 4 years.
Yeah.
The next one, we know it's not true, so it's no fun that we're not going to debunk it, but C corporations can deduct 100% of their dividends.
Now, while C corporations can deduct wages,
Yeah.
we have to remember dividends, kind of like LLCs with distributions, when they're issuing that to their shareholders, they're actually taking a subset of their retained earnings,
Right.
which is on your balance sheet. Those are not deducted. The company already paid taxes on that money before the dividends are actually distributed. So they are not deductible at all.
Cool. You just touched on this, so we'll just touch on it again so you can give a real life example of like how people balance their tax obligations. You can avoid double taxation by reinvesting all profits.
Oh yeah, we did talk about that earlier because I was trying to give an example of how C corporations can mitigate their tax liability for themselves. But when they're reinvesting that money, okay, they are paying their corporate tax rates, federal, state, but they are pushing out the obligations on the double taxation.
On the point of the shareholders, which we touched earlier, one of the things that's out there and it's talked about a lot is that the shareholders are liable for all the corporation's debts.
Yes, that is one of the reasons we use corporations, because that is not true. But there is instances where it can be true. So let's discuss that a little bit. So typically going into forming of a C corporation, say I'm the founder, so I become the CEO. Maybe there's not a lot of shareholders just yet. We're doing that so that we're not responsible for the corporation's debts, because the company is actually responsible for its own acquisition of debt and its own liabilities separate from its shareholders. Now, where we might run into a situation when that is not true, and we do see it a lot more these days, considering are in the lending world.
Yeah.
You go to get maybe a business credit card, your corporation doesn't have established its own credit yet. You go to get a loan and they require a personal guarantee. Now, typically you'll see your senior level executives personally guarantee those types of loans. Now, because they're putting a personal guarantee, they are personally can be liable for that debt if something were to happen to the corporation and it couldn't pay its obligations, that debt. But you're going to know that going into it.
Like right. So there are those one-off caveats, but there'll be situational structure around that they knew they were going into that.
Absolutely, yeah.
For sure. All right, we talked about this, and we know that everyone's a little bit different, but that the C corporations don't have to pay state taxes.
Yeah, they do. Skip that one. They don't have to pay state taxes. Let's just do C corporations. No, we do have to pay state taxes. C corporations are subject to the same federal and state regulations depending on where they're formed and established. For example, although, I do see a lot of people saying, I'm going to form my C corporation in Delaware because they have no C corporation taxes. But that's great. But unfortunately, if you're operating it out of Arizona, you're still going to have obligations to the state that you're operating in. So they do have to pay both federal and state taxes alike, just like everybody else does.
Got it. Is it true, or is it a myth, that C corporations can issue unlimited types of stock?
Well, unlimited is a strong word, but I think what the truth behind all that is that the C corporations can have unlimited shareholders. They can issue different types of stock, preferred stock, common stock. Sometimes you'll see different classes of stock, A, B, C. They can name them whatever they want. But what's key to that is how they're clearly defined on what they're allowed to do, these different classes, right? So while preferred stock may get paid their dividends first, or they don't have voting power, common stock has voting power. These different classes all are going to have different things they're allowed to do or they're eligible for, and that's what makes them, but that has to be clearly defined. So unlimited classes, I mean, if you could unlimited
anything,
slice that up. But I think in general, that's not really a valid statement.
Right.
I mean, they can, but most don't.
Most don't. Yeah. One of the last ones I want to talk about, there's two more that I definitely want to touch on, is one of the myths is going to be C corporations don't need an operating agreement.
No, they don't need an operating agreement in the sense that we've talked about it before, especially with partnerships, where I kind of beat that one with a hammer.
Yeah,
a dead horse. But they do have bylaws, and they're like basically trying to serve the same purpose, where operating agreement is telling the partners of a business what they can and can't do, what they're allowed to do, how they can
get out,
all of those kinds of things, and they're pre-agreeing on those. The bylaws of the company are essentially doing the same thing for the C corporation itself. What can the different directors do? What are they, is it required that the board of directors have a unanimous vote? How many people sit on the board of directors? What kind of debts is the company allowed to enter into? So the bylaws establish a lot of the restrictions around the governance around what the company can do and what its governing board can do.
Yeah, this one kind of ties into this last myth that I have here, is C corporations can ignore compliance after formation.
I don't know that anybody can ignore anything after formation. So that could have been the biggest myth of all time, because corporations are going to have ongoing compliance just like anything. They have annual meetings. They are supposed to keep very clear documentation and minutes of all their decision making and their processes, and that's what's helping to secure the limit the liability to the shareholders, and it's basically its basis. So that compliance is extremely important to do on an ongoing basis, because without that, you could have issues down the road if you were ever sued or something, where people can easily pierce the corporate veil because you didn't treat the corporation as its own entity.
Its own body there. Yeah, got it. Well, those are the myths I have for this one. I wouldn't say that there's a lot of myths going around C Corps nowadays. Like we talked about last episode with the S corporations, that's where we hear so many things go on.
Yeah, because they're so popular
right now. May or may not be overused. But these ones were more structured, so you handled them with ease. This last segment, we're going to talk about a couple of last things. It's going to be tax planning, compliance, and the corporate governance. We talked a little bit about a couple of those already, the compliance and the corporate governance. So I really just want to touch on tax planning. Tell me about different strategies for minimizing the tax liability with C corporations and the importance of needing to consult with tax professionals as you may want to grow into a C Corp or start one.
Yeah, and we've talked about tax planning in the past, and I think it's just often misunderstood as a term we use to say, how do we reduce taxes? Which that is a subset of tax planning.
Yeah.
Mitigation of your tax liability. Tax planning in of itself is just a plan. Let's understand where we're at, where we want to be, and how we're going to get there. That's what a plan is, right? We do that when we go to Disney, I think. We set up a plan, where we're going to go first, and second.
What are we going to eat? And what are we going to eat? That's the most important. Eat.
So we're just equating this to Disney. So anyway, what we try to look at in from a tax planning perspective in a C corporation is making sure you have clear documentation of your financial state, right? So your P&L, your balance sheet, cash flow statements, good infrastructure around your finances. If also really important from a planning perspective, that we can look at fairly accurate forecasting for the business. So maybe it's August right now, and we still have 4 months to go, but we might look at that corporation and go, okay, in the past, typically our fourth quarter does 20% better than our third quarter. We can do forecasts out for that, and then start to look at, well, what's going to happen to the company at the end of the year if these forecasts hold true. And then we can take a step back and say, okay, if that's the case and we know this is what our tax liability is going to look like, what do we want to do with that? Is there any tax credits we can take advantage of, or things that we were looking at doing in the future that we can actually pull in.
To this,
So obviously looking at some of those traditional things allows us to basically see where we're headed and can we mitigate any of those types of, can we do anything to make sure that that doesn't happen, or it does happen with a more clearer picture.
Got it. Understood. When people come and they want to consult a tax professional, right? We have people come and visit us all the time. What is like one tip you would give someone if they're wanting to start a C Corp and expand, but they don't know who's going to handle the books, who's going to keep their financials? Like, what's your...
Well, I gave this
What are you imparting
recommendation.
on them?
Well, I give this recommendation to anyone starting any business, right?
Mm-hmm.
A business is not a hobby. I mean, it needs to be treated as such, that, with good. But when someone's coming into me and saying, I really want this, I want to start a C corporation, the first thing I think of, due to the regulation, audit risk, all of those things, I'm like, okay, look, you need to have really clear records, really good documentation, well thought out financial pictures. So we encourage them to definitely make sure that they have some type of, they're doing something to keep their financial records.
Right.
I don't care if it's QuickBooks or, any of these other applications out there that they might be using to do so, and have them reviewed regularly by a professional, because things change all the time.
Yeah.
And then,
we know.
Yeah.
Yeah, no, and I think that's when people come to us with their really good ideas of starting the business. We always want to tell them, like, hey, the foundation is the most important part. It's your starting point of your business. You have to make sure that you're treating it like, your brand new little baby. They need all the health and care up front before they can grow.
Yep, that's true.
Well, that's it. That's all I had on the tips for this portion of our 4th episode. As we said before, we are running into that entity structure of our first 4 episodes, just to give you a basis of us and as the Tax Sisters. As we grow into more episodes, we plan on bringing some guests onto the show.
We do.
Yep. So our guests are going to kind of give us an idea of how they started, kind of their story as a business owner, their goals, aspirations, and kind of what it took to be a business owner in this space, with all the compliance and burden that the IRS has put onto us, but how they are able to easily navigate it by having their trusted professional at their side.
Absolutely. So that will be next week.
Yep. Talk to you soon.